Perhaps the biggest surprise from the Federal Reserve's meeting yesterday was that it's going to be using part of its proceeds from its balance sheet and putting them back into mortgage-backed securities, not treasuries. Nick Timrose joins us on set now to discuss why they're doing this. Hello, Nick.
Hey, Kelly.
And what this means for consumers. So no one was necessarily expecting this, but it does make a certain amount of sense.
Right, it makes a lot of sense. If you think about the government right now wants to spur a new wave of refinancing. Federal regulators in the White House are talking about refinancing more underwater borrowers. The Fed bought, $1.25 trillion mortgage-backed securities. Their portfolio has run down to about $885 billion.
This was from the very first quantitative easing program they did back a couple years ago.
But if you think about it, if you're going to spur a bunch of refinancing, and so you're having a bunch of bond sales coming out of the Fed, and so the Fed is a net seller, and now the money managers in the market have to buy up more of this MBS that's coming onto the market, you really could offset the impact of a refinance boom. If, again, you have the Fed kind of flushing all of its MBS out there that now has to get bought up by private investors. So by becoming a balanced buyer, you really are laying more groundwork for a refinance boom that might reach more people. And of course, rates now could head well south of 4% for a 30-year fix.
David, it's interesting actually. If you look at what's happened with mortgage-backed securities, investors really backed away from them over the last month or so.
Absolutely.
They were worried about risk. They were worried actually about the Obama administration's potential refi plans that could cause some losses there. And so as a result, that spread between, say, the 10-year, which we mentioned again, 1.78%. I feel like I just need to keep saying that because it's so amazing. But so if that spread between the 10-year and the average 30-year mortgage were still as narrow as it was in the spring, you could get a mortgage right now for 3.3% or 3%. Right. So they're really trying, it seems, to sort of drive that down, so that because mortgage rates still were hovering around 4.
I don't think we can underestimate the pressure of government on banks to lower interest rates at this point. It's at the end of 2010, I did a refinance, and I had nothing absolutely to do with it. It was my bank calling me saying that they were under pressure from Fannie Mae.
Right.
Anybody who was basically about a full percentage point away from the current rates or over that, they were pushing into refinancing. So the government is very serious, I think, about getting these mortgage rates lower, especially for those underwater borrowers.
Well, and I think what's interesting here is that the Fed is back to buying, investing in credit-sensitive assets again. They're not going to raise their holdings of mortgage-backed securities, but during QE2, they said, we're not going to reinvest in MBS, we're just going to do treasuries.
Right.
And now they're going back to credit-sensitive assets. I think it could be a sign that the Fed is saying, we recognize housing as the problem here, and we're going to do more. And if this doesn't work, it'll be interesting to see what comes next. I really still have questions about how much impact refinancing is going to have, because you're just taking the same borrowers who refied when rates went below 5%.
Right,
and
now doing it below 4.
Doing it again below 4%. The two big problems in the housing market, it is, we're not talking about making it easier to purchase a home. And in a lot of these markets where you have a ton of foreclosures, that's really the problem you need to solve for.
Right.
And then negative equity. In the state of Nevada, half of all people with a Fannie Mae mortgage they have loan-to-values of 125% or higher. So that entire state is just way underwater, and until you begin to deal with that, it's hard to see how you're really going to get a recovery in housing.
It's true, and that may help explain some of the negative reaction to the Fed's move, which, even if it helps a little bit, is not going to solve any problems.
And that doesn't mean that it's not worth doing at all. It may not have the impact we're all looking for here.
Nick Timrose. Nick, thanks very much.